Hi, welcome to my very first live broadcast. I've been super nervous yet excited all day. It feels like you're throwing a party and you're hoping people will show up, but regardless, we're gonna have a good time and we're gonna enjoy the live broadcast. All right, so I have everything kind of going and I'm ready to kind of jump right in there. If you are kind of joining in, then please feel free to send me some questions in the live chat box, and I will answer questions as they arrive. Um, I think that's pretty much it as far as like an introduction. If you don't know, my name is Professor Nance. I am an accounting instructor for a couple of colleges. And I consider myself like a translator. Basically, I translate accounting to people who don't necessarily understand accounting but want to learn accounting or just have to learn accounting because they're making them do that. So either way, I am here to help. I am more than happy to provide whatever help that I can to you guys. And so until we have some questions kind of pop up on the feed, what we're going to do is I've prepared a couple of I guess examples to kind of go through just to get us through the first part of this broadcast. If, like I said, at any time you decide you want to kind of jump in there and ask some more questions, then please feel free to do so. What I'm doing right now is I'm going to put a message in the chat box so that people, as they join, will know that they can send their questions at any time. Alrighty, so we are good to go. So what I have done is I've prepared a problem that is based on one of the more complicated things in accounting, which is the adjusting entries. So if you are in an accounting class, you've probably done pretty well on the first exam and you're thinking, okay, I got through that whole debits and credits thing, and so I'm good, I'm ready to go. However, then you get to like chapter 3 or chapter 4 when they talk about the accounting cycle and they talk about adjusting entries and closing entries and deferrals versus accruals and things like that. And you're like, oh my gosh, what has happened? I want to go back to debits and credits. That's what I felt comfortable with. All right, so the problem that I've prepared today for us to kind of walk through is based off of an adjusting entry problem. So what happens is we'll start with an unadjusted trial balance. Then we'll have a list of a couple of things that we need to adjust at the end of the period. And then from there, we would be able to then go on and prepare a post or an adjusted trial balance. All right, so I'm gonna switch us over so that we can see the example that we have prepared here. All right, so what you'll see to the left of the screen is a copy of the unadjusted trial balance that I have prepared prior to this class. If you are in one of my current classes, you will notice that this actually does come out of one of our textbooks. So this problem may look a little bit familiar to you. So as you can see, when we're looking at any trial balance, anything with the word trial balance, we're looking first to make sure that our totals balance, which they do, because in all areas of accounting, we always want our debits to equal our credits. All right, so once we have looked at that, we see that our debits do equal our credits, then we're ready to move on. And now we're looking at the account balances. We want to make sure that if it's if it's an asset, then it is listed in the asset section. And if it is a liability, then it is listed in the liability section, and so on and so forth. So we want to make sure that everything has its correct balance. All right, and it does appear that that is the case. So from this unadjusted trial balance, what we're going to do is we're going to prepare these entries right here. All right, so basically when you're thinking about this step in the accounting cycle, what's happening is we got to the end of the period. Normally in accounting, we prepare entries when something happens, a transaction has happened. We paid cash for something. We bought something, we spent money on something. However, for the purposes of adjusting entries, there will never be any cash. All right, so that's like very important. I'm going to bold that. I'm going to put it in red. So when it comes to adjusting entries, you should never, ever, 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 ever have cash in your journal entry. All right, so that's the one of the easier ways to remember that you're doing something wrong is if you get to a journal entry and you see you have cash, then it's wrong. All right, then that part is wrong. Okay, so for part A, it tells us that we have depreciation on our equipment. So we're just gonna record the journal entry here. We're gonna do our debit first, of course. Our debit for this situation, if we're recording depreciation, anytime we're recording depreciation, we're always going to debit depreciation expense for, they say $3. We're a pretty cheap company apparently. And we're going to credit accumulated depreciation for $3. All right, anytime you see anything about depreciation when it comes to adjusting entries, this is always, always, always going to be your journal entry. The only thing that's possibly going to change is going to be the amount. All right, everything else, it's going to be the same. All right, so we have our debit to depreciation expense and our credit to accumulated depreciation. And just for kicks and giggles, we're going to also just really quickly denote what type of account each of these are. Depreciation expense is always going to be an expense account because it ends in expense. That should be pretty easy. Accumulated depreciation is a contra asset account. Okay? So that is that's just something for you to keep in mind when you're going through this. Just, you know, what happens in accounting is you should have, you know, information. You're going to learn information from chapter 1, chapter 2, and it's going to keep building on itself. So all of the information that you're learning should theoretically continue to build on itself as you go from chapter to chapter. So a lot of times what will happen is your instructor will say things to you like, you should know that already. Well, the idea is that we're like a house, right? We're starting at the bottom, we're building the foundation, and then we're installing the walls, and then we're doing, you know, we're going up and putting in the drywall. And I should know all of this stuff because my dad is a contractor. So we're building the walls, we're putting in the drywall, but you know, you don't want to build the second floor before you build the first floor because that's not a good idea. So essentially what's happening is from chapter 1 all the way up, we're building on the foundation. So if you do not understand what an asset is, what type of accounts are assets, what type of accounts are liabilities, and so on and so forth from chapter 1, I would definitely advise you to go back and review that. All right, so let's go into the second one. So from here we go to B. In B, it tells us that we accrued salaries of $6. All right, anytime we are accruing salaries, remember, cash is never, ever, ever, cash is never, ever, ever going to be a part of our adjusting entries. So we're just going to immediately kind of throw out the notion that there may be some cash involved in this. All right, so accrued salaries, that means we get to the end of the month. Let's say the end of the month is on a Wednesday, but our people don't actually get paid until Friday. In a case like that, we owe them for all of the days that they've worked up until Wednesday, but they actually won't get paid until Friday. So with that said, we still need to record something. We want to make sure that all of these expenses associated with the given month or the given year that we're in are recorded in that month and in that year. So we want to accrue so that we can go ahead and recognize those expenses. All right, so with that, what we're going to do is we're going to debit salaries expense, and then we're going to credit salaries payable. All right, and they tell you the amount for this one as well. That's 6, and that is 6. All right, and just as a reminder, salaries expense is an expense account, And then our, and I put these on the wrong line, didn't I? Yep. All right, and then our salaries payable is going to be a liability account. Just a helpful hint, anytime you see that word payable, generally speaking, you're going to associate a payable as it's going to be a liability. If we have to pay something, we owe something. Therefore, it is an obligation for us to spend our money. So it is a payable. It is a liability. We are liable to pay something like that. Alrighty. So I am going to just keep going at this point. So now we're going into C. In C, they tell us that the $12 of unearned revenue has been earned. For part C, they're referring to this right here. All right, that $12 of unearned revenue has been earned. All right, so just really quickly, let's think about what unearned revenue is. Unearned revenue means that somebody came and gave you $12, but you haven't done anything for it yet. Okay, so it's kind of like it's a deposit, or it's, you know, it's money that has exchanged hands before you've done anything to earn it. It's a liability, because if something happens and you falter on your agreement, then you have to pay that money back. You have not earned it. So we cannot record it as revenue because it hasn't been earned yet. All right, so instead we record it as unearned revenue. All right, so just as a reminder, our unearned revenue has a credit balance. So if we have now earned it, to get rid of that credit balance, we need to debit the account. All right, so we have the whole 12. Unearned revenue is actually a liability. Most accounts that end in the word liability are going to be considered, most of the accounts that end in the word revenue are going to be considered a revenue account. This is a special situation because it is unearned revenue, and because of that word unearned, that's what makes it a liability. All right, so then we're going to credit revenue. All right, and revenue is a revenue account. All right. We're looking good here. All right, so we've gotten through the first three. So we're gonna keep on going. All right, so now we go to D, to D. D, one of my favorites. All right, this one, I guess it shouldn't be my favorite because it gets my students every time, but it's my favorite because it's a great teachable moment. All right, supplies confuses students a lot. Supplies, when they tell us in this situation, they tell us that that the amount of supplies available at the end of the year is $15. All right, so a lot of students, when they perform this journal entry, what they want to do is they want to use that $15 in the journal entry. I mean, it's there, right? Let me just give you a helpful hint. Let's go back to the Excel. When you are looking at this amount here that they have shown here, just note this number will never be in the journal entry, the JE. Okay, so that's another red bolded hint. Okay, this $15 that they tell you right there, that is never going to be in your journal entry, because what they are telling you is that you had a certain number of supplies. Now you only have this amount of supplies. So the number that will appear in the journal entry is going to be the difference between those numbers. All right. So we're going to look over here at our handy dandy unadjusted trial balance, and we see that we had $24 in supplies, and now they're telling us that at the end of the year, what we had available is going to be 15. All right, so our goal, our task, what we're tasked with is to get from the 24 to the 15. Another way of looking at that is if we come over here and we look at the T account. All right, the beginning balance for supplies is 24. That's what they told us, okay? Now they're telling us we're at the end of the year. Our ending balance is 15. If we're looking at the debit side versus the credit side, how do we get a debit to decrease down? How do we get a debit to go down? We have to pop something over here on this side, right? So in order for us to bring our supplies down to 15, that must mean that we used $9 worth of supplies. Okay? So this is our golden number right here, that 9. The $9 is what's going to actually show up in the journal entry. It's not going to be the 24. It's not going to be the 15. It's going to be the 9. Okay? All right, so then we go back over here to the trial balance, and now we're ready to prepare the journal entry. We're going to debit supplies expense for 9, and then we're going to credit supplies for 9. We're bringing that down. All right, supplies expense is an expense and supplies is an asset. Alrighty. Okay. So we're gonna keep on moving, and we're gonna go to the last one. E. In part E, they tell us that our expense has, our insurance has expired for $15. So in part E, to record that our insurance is expiring, that means we're going to look at our prepaid insurance account here. Previously, at some point in time, probably at the beginning of the year, we said, you know what, we know what our insurance costs for the whole year. Actually, what probably happened is the company required us to pay the insurance for the whole year. That's normally what happens. That's what happens at the organizations that I've worked for. So at the beginning of the year, it's kind of like, for example, when I was in college, you know, I lived off of refund checks. It's, you know, it just happens. Okay. So at the beginning of the semester, I would get kind of a big payout that was supposed to pay for my living expenses. Well, because I wanted to do some other things with the rest of the money, I would take and pay all of my rent for the whole semester to my landlord in August. So from August, I'd pay August, September, October, November, and December. So I would pay 5 months worth of rent to my landlord in August, so I wouldn't have to worry about it. From the landlord's perspective, he hasn't earned that money, but that's kind of the other side. So we're looking at it from my perspective. From my perspective, I do not owe 5 months worth of rent in August. I only owe 1 month worth of rent, which means that the other 4 months are going to be considered prepaid. I've already paid for it, but I have prepaid my rent. That's the same thing that happens with the prepaid insurance. So with the prepaid insurance, we've taken and we've paid our whole insurance premium for the entire year. We have, from a cash perspective, we've paid it, but from an expense perspective, we do not owe it yet. So we're going to slowly kind of pull back from that every month. We're going to go in and take out what we owe for that specific month. At the end of the month, that's going to be the adjusting entry. All right, so we're going to go back and look at it. All right, so for this one, with the adjusting entry, we already talked about the prepaid insurance right here. All right, so our prepaid insurance, we're trying to bring that down. This is currently at 18. They tell us that 15 of it has expired. So first of all, we're going to debit insurance expense for 15. And then we're going to credit, right here, credit prepaid insurance for 15. All right, insurance expense is an expense account, and prepaid insurance is an asset. All right, it's an asset because we have paid something that we do not owe. Therefore, if something happens and we cancel our insurance policy or our prepaid rent, we move, whatever the case is, then that person, our landlord or the people who have our money, they got to pay us that money back. Okay, so that is an asset to us because until we actually use it up, until we owe that money, then they have to pay us back. All right. So that's pretty much the adjusting entries that I had prepared for us to kind of go through and speak and talk about this evening. So I wanted to at least have something to start us off with. This is the first time that I'm doing this whole live feed situation. So I see that there's a couple of people watching. I wanted to see if you guys have any questions that you would like for me to answer. Maybe you're not in principles of accounting, or maybe you've already passed this part of the accounting and you want to see something else. So please, please, please feel free to type something in the questions box and I'll answer those questions. Let's see, what can I do in the meantime? Let's see, what else is something. So just while I'm waiting for hopefully some questions to pop up, I also wanted to just kind of point out that I am working on more videos to upload. I've recorded a couple of videos specific to our financial statement. So there's one video for the income statement, one video that I'm going to be uploading that is for the balance sheet, and then one for the statement of retained earnings or the statement of owner's equity, depending on what type of accounting you're taking. So look for those to be posted very soon. Let's see what else. You know, and I just love feedback from you guys. If you can just send me messages and kind of kind of just give me an idea of the type of things that you want to see and the things that you have, then that would be great. All right, so I do see that we have a question from Bree. She wants some help with the income taxes incurred but not yet recorded. All right, so if we have income taxes that have occurred but are not yet recorded, it's going to be similar to the accrued salaries, where we owe the money. Technically we owe it, but we have not actually paid it yet. So I'm just going to scroll down here and kind of put like an F. And so in that case, if we have some, oh, haha, I forgot to switch it back so you can see what I'm doing. Okay, there you go. So what I'm going to do is I'm just going to kind of make up an F here. And what we're going to do is we're going to have our income tax expense for whatever the amount is. I'm not, you know, we're just making this up as we go. And then we're going to have a credit to income taxes payable, or income tax payable. Let's just stay consistent. All right. So it would be expense for the income taxes and expense account, and the payable, anytime, remember, payable is going to be a liability. All right, so anytime you see that word payable, you're going to automatically think this is a liability account. Good question. That's another common adjusting entry that occurs with the let's see. Most of the time when they tell you that it's something that has been incurred but not yet recorded, that's going to be something where you've incurred the expense. It's something that you owe, and therefore it's something you need to record as an expense, but you haven't recorded it yet, which also means that you have not paid it yet. And so anytime you have a situation like that, then more than likely it's always going to be a debit to some type of expense and a credit to some type of payable. Good question. All right. All right, so yeah, so if you have a chance to look at some of the other videos that I've done, the one for deferrals versus accruals kind of goes through this a little bit, where it talks about like the 4 different types of adjusting entries. The thing about this chapter and adjusting entries is most of the time it's just a formula. Once you learn how to do it one way or one time around, it's going to be the same. Like this part F and B, if you look at them, they're pretty much the exact same entry. The only thing that changed is the thing before, like it's salaries expense and salaries payable versus income tax expense and income taxes payable. So it's kind of, it gets repetitive. All right. So it is something that you can kind of like when you, as you're practicing it, you'll kind of notice a pattern, which is good because patterns help you really internalize and learn things. Let's see. The other thing, like I said, supplies is one of my favorite ones. The main thing to remember about supplies is that the number that they give you in the adjusting entries is never going to be the number that you're going to use for supplies. You're going to have to come over here and work it out on the T account, or you can just subtract. It's usually just going to be a subtraction, but it's just something to know. Another thing is sometimes when they tell you that like your insurance has expired, sometimes they'll be tricky about it, and they'll say at the end of the year there was only $3 worth of prepaid insurance or something like that. They're basically having you do the same thing you're doing with supplies, where you're having to kind of go to the T account and work it out, where you're saying, okay, with prepaid insurance, we started with 15. At the end of the year there was 3, and then how do we get from 15 down to 3? Oh, we need to do a 9 here. Okay, so it ended up, well, I didn't mean for that to be the same number, but it ended up that way. All right, so there is sometimes they will try to throw you off like that with these adjusting entries, but like I said, once you kind of learn the game, so to speak, it's just the game, it's just a formula and things like that, then I think, you know, you'll probably be okay. All right, so once again, great question. Let's see, I guess I'll just wait for a couple of minutes and see if anybody else has any questions. And I know we scheduled this for an hour, but if we don't have any other questions, I'm not just going to keep rambling on and on. Nobody wants to hear that, and nobody definitely wants to see that as a playback later. So I think what we'll probably try to do is just try to do a couple more of these in the future, and maybe have a little more time before we do these. One of my schools that I teach for, they're actually going on fall break tomorrow and Friday, and so I wanted to try to get in a session before they go on fall break, even though mentally all of them are probably already on fall break, but I'll probably try to do a couple more of these based on the feedback that we get. So I'm just kind of waiting and seeing if we have any other questions pop up. This has been pretty good. You know, I told you at the beginning, if you were tuned in, then you saw that, and I was talking about how nervous I was all day, just because of it's kind of like throwing a party and you're like, oh gosh, is anybody gonna show up to the party? So I'm happy that I have a couple of people watching live, so thank you for joining in so I don't have to be at the party by myself. All right, we do have another question. What about what do you do with the retained earnings in the closing process? Fantastic question. All right, so in the closing process with retained earnings, what happens is a lot of times what people will want to do, and what we're going to do is we're just going to use this table. I'm just going to duplicate this tab really quickly, and you'll see me use a lot of Excel because Excel is awesome. So let me take you and show you what I'm doing. So I was talking about it and didn't even show you what I was doing. All right, so anyway, I just made a copy of the trial balance tab so that we could use that same information. Let me not do it that way. So for the the closing entries, I'm sorry, what we're going to do, I'm going to be lazy so I don't have to rewrite all of this stuff over again. All right, actually I can't do that. All right, anyway. Okay, so for the closing process is a little bit different. So basically, before you can close the accounts, you have to know which accounts to close, right? You know, you don't want to go through closing all of the accounts. So within the closing process, what happens is we only want to close what we call the temporary accounts. The temporary accounts are just our revenues and our expenses. That's it. Okay? Everything else, all of this stuff up here, those are our permanent accounts that are on the balance sheet, that show up on the balance sheet. The misconception that a lot of students have is that they want to consider retained earnings a part of like a temporary account. Retained earnings is not a temporary account, okay? Retained earnings is a permanent account. The only reason that retained earnings comes into play is because when we prepare this closing entry, it's not going to balance. And therefore, we need a little help to make it balance. That is where retained earnings comes into the closing process, okay? You will not try to close out this $32 in retained earnings. If you try to do that, you'll know it's not going to work because your journal entry won't balance. All right, so to close out our temporary accounts, we're going to do the opposite. We want to, if we have a credit balance, to close it out, we need to do the opposite. So just really quickly for the visual of it, in order for us to close out revenues, let's put it in a T account. All right, so currently we have a credit balance of 75 in our revenues accounts. We want this sucker to be 0. We want it to be 0. We want to clear the scoreboard. We want to go into the next year with a fresh, clean slate. So we want this to be 0. So in order to get this down to 0, what we have to do is put a debit on this side. We have to do the opposite. We have to close it out by debiting this account for the same amount. Whatever we have currently on the credit side for revenues, that's what we're going to put over here on the debit side. All right, so our debit is going to be to revenues for 75. Okay, I'm going to leave a little space here because this is where we're going to have our little plug area where retained earnings is going to come in, and I don't know if I'm going to need to debit retained earnings or credit retained earnings, so we're just going to leave it blank for right now. All right, so our credit, the other opposite is we're going to have to credit all of our expenses, and I could show you on the T accounts, and let me know if you want to see them on the T accounts, but it's pretty much the same premise where we normally, our expenses normally have debit balances. They normally have a debit balance, so to get rid of that debit balance, we need to credit it. Utilities expense. I meant to give a disclaimer at the beginning that I am horrible at spelling things. I rely very heavily on spell check. All right, so here now we're at this point. We've already closed out everything that needs to be closed out. So we've got all of our revenues in here. We've got all of our utilities. I will tell you that there is one anomaly, and I'm going to put it in like a funky color. Let's see, maybe that green doesn't look good. Maybe like a purple or something. Dividends is also going to be a temporary account. Some people will include dividends in this initial journal entry when they close out their revenues and expenses. I usually put it separately just because it's like something weird and completely off in left field. So I close it out by itself. All right, so looking at this now, we have 18 and 12 worth of credits, and we have $75 in debits. That means in order for this to balance, because remember we're accounting, we want to make sure that we're always in balance. In order for this to balance, it looks like we need more credits, right? So what we're going to do, and I don't know what it is. Let's just say this is why I like Excel. So I'm just going to be lazy. So we need $75 more in credits. So what we're going to do is we're going to credit retained earnings. All right. That is the only way that retained earnings is introduced into the closing process. It is a plug. So I'm just writing that we're gonna use this as a plug to balance the closing entry. That's all. That's the only way that retained earnings comes into this whole closing process. All right. And then the other journal entry where we're going to close dividends. Dividends, if you notice here, dividends is a contra equity account. And because it is a contra equity account, it has a debit balance. In order to close something that has a debit balance, we have to do the opposite, which means that our debit is going to be to something up here. We're going to leave that blank for right now. And our credit is going to be to dividends for the 6. All right, same rules apply. We're going to have to use this retained earnings to plug this journal entry to make it balance. So we have $6 worth of debits. So to make it balance, we need $6 worth of debits. All right, and those are pretty much the closing entries. Closing entries are like the shortest thing ever, but they can, like, most of the time they confuse my students. They always confuse my students. And I think the reason why is because of you've been training your mind as a part of that foundation. Let me just pop back over here so you can see me. As a part of that foundation, and we're building this house, right? You've been training your mind to think, okay, right side, left side, you know, debits equal left side, credits equal right side. Revenues are always on the right side, and therefore they always have a credit balance. So you're kind of repeating this over and over and over to yourself. Then you get to closing entries, and we're telling you to debit revenues. So it completely confuses you because you're like, but you've said that I'm supposed to credit revenues. Well, yeah, you're supposed to credit revenue. The thing is that you need to remember is that in the closing process, you are doing the opposite. The only way to close an account is to do the opposite. So it's not that you would ever debit a revenue, but in order to close it, you have to debit it to do the opposite, okay? Hopefully that helps, like, drive that point home a little bit more. I think closing entries can be one of an easier thing. It's just, like I said, a lot of times students really get mixed up because of that whole, like, the foundation. It goes against everything that you have been learning in the first 1 or 2 chapters or 3 chapters in your accounting class, and we resent that. We don't like that. We don't like change. So yes. So anyway, that's the long answer for how retained earnings fits into the closing process. Hopefully that answered your question. Alrighty. So anybody else? Does anybody else have any other questions? Just watching my little feed here to try to see if there's any other questions popping up. This is fun. This has actually been really fun. So I look forward to doing this again. Alrighty, so like I said, once again, we're waiting, giving a couple minutes for anybody to come up with any questions. And if you want a copy of the Excel document and the journal entries and stuff that we've been going through today, then just shoot me an email. If you're one of my students, you can shoot me an email at my school email address. If not, then I'm going to post, or it's actually already posted in the info section, my professor at Nance Accounting Academy email address. All right, so please feel free to shoot me an email there, and I'll gladly respond to your email and just shoot you over a copy of this Excel file that we've been working on today. All right, it looks like maybe we're good on questions. Alrighty. So I guess we can just get ready to kind of close out. So thank you guys so much for those of you who are able to tune in. Please make sure, and if you don't mind, share the video with your classmates and anybody else you know who's taking accounting, so that they can see the information as well. Yeah, I am recording this, so it will be on my Facebook page. I don't know how long it takes, but we'll see. But it'll be posted at some point. I think that's pretty much it. I'm so glad you joined me, and yeah, I look forward to doing this again. If you have any other questions, you think of anything that comes up after we end the video, then please shoot me a message on multiple places. I'm going to close out with a screen that has all of my social media information, so that you can feel free to kind of follow me on there and find out about upcoming posts and things like that. Alrighty, thank you so much. Have a good rest of the day, and for my CPCC students, enjoy your break. Bye.